Gary Gensler, the chairman of the SEC, has come up with a proposal in a more than 1,500-page document that will, or that seeks to improve competition and benefit both everyday investors and institutional investors. So this will be the first in almost 2 decades to improve prices and transparency for small investors. But its plan has sparked immediate resistance from the market-making firms that dominate the system. Put together, the proposals would produce the biggest changes to U.S. equity trading rules since 2005, reshaping the business of executing deals for retail investors. The agency's focus on the inner workings of the U.S. stock market was revived after pandemic lockdowns prompted an explosion of activity from consumers. It culminated in the dramatic surges in the prices of popular so-called meme stocks like GameStop and AMC last January 2020, last January of 2021, I believe, and the imposition of temporary trading restrictions by some brokers to stop more investors from piling in. The halts in trading drew fire from politicians in Washington. The most immediately contentious of the regulator's proposed rules is a new auction mechanism that will force brokers to offer retail investors orders to a wider group of trading venues if they are less than $200,000 worth. Another proposal on so-called best execution would require brokers to document exactly how they looked at venues to ensure they received the best price for their customers. Currently, the definition of best execution is set by FINRA and not the SEC. So according to Gary Gensler, he believes a best execution standard is too important, too central to the SEC's mandate to protect investors, not to have on the books a commission rule text. So Gary Gensler obviously is a Democrat as well, and he was appointed by President Joe Biden. So the proposals have the potential to boost business for stock exchanges by allowing them to offer share prices in fractions of a penny, just as off-exchange dark pools and wholesale traders already do. Okay, so the president of IEX Exchange, Ronan Ryan, supported the reforms, calling them a constructive and positive effort to improve transparency, increase competition, and ensure that investors can access the best prices available in the market. So the meme stocks incident highlighted the practice of payment for order flow, in which big trading firms such as Citadel Securities and Virtue Financial buy the customer orders of retail brokers such as TD Ameritrade, Charles Schwab, and Robinhood, rather than go directly to the stock market. While the practice helps big brokers offer retail investors cut price or free trading, the SEC fears it may not lead to the best deals for clients. The regulator's research estimates that small investors are out of pocket by as much as $1.5 billion annually, or 1.0 cents per $100 traded, because of what it describes as a competition shortfall. Gensler indicated that in September, off-exchange trading volume accounted for 42% of all equity dealing volume. Earlier data from 2009 showed that this year was roughly a third, that is around 33%. So while the SEC's proposals would not ban payment for order flow, they would probably make it far less appealing for brokers and wholesale sellers alike. Citadel's, the market's largest market maker, indicated that the U.S. equity market is the envy of the world, and any proposed changes must provide demonstrable solutions to real problems while avoiding unintended consequences that will hurt American investors. Okay, so a majority of the SEC's 5 commissioners voted in favor of each of the proposals, but 2 voted against the auction and the best execution plans. Hester Pierce, a Republican commissioner, indicated that the regulator has a habit of trying to micromanage the markets, a habit he believes is on display right now based on what the proposal is trying to achieve. Okay, so the proposals will be open for comment until at least March 31st of 2023. Gensler also indicated that a reform was needed. Okay, the market has, according to him, the markets have become increasingly hidden from view, especially for individual investors. This is in part because there isn't a level playing field among different parts of the market, whereas dark pools are. This is in part because there isn't a level playing field among different parts of the markets. That is wholesalers, dark pools, and lit exchanges. So, in a different issue altogether, the commissioners have also held a meeting on Wednesday, the 14th of December, 2022, and they approved a final rule that will force company executives to wait 90 days to sell shares after establishing the so-called 10B 5-1 plans, which are designed to enable automatic stock sales that adhere to insider trading rules. So the 90-day period will end a controversial practice in which executives sell stocks days after creating a plan, raising suspicion that they may have acted with insider information. Peers also raised concerns about some details of the insider trading reforms, but said they will do more good than bad and allow insiders to trade without fear of liability while making it more difficult to misuse the rules. So, yes, U.S. stock trading faces the biggest overhaul in 2 decades. That is as proposed by the chairman of the SEC, Gary Gensler. Okay, so see what you make of all of these things. And this piece relied heavily on the piece written on the Financial Times of Friday, the 16th of December, 2022. And thank you very much for watching this video.